All right, guys, let's continue. I think this is where we have stopped in the last session. We did a really good sum. Now, I've already marked the previous sum as a master problem. So, master problem is compulsory. You have to revise it the day before the exam. Keep that in mind. Okay. Right. Now, moving on to the next one. Now, we're going to move on to question number 50. Right. So, in this session, we'll be finishing off 50, 51, 52, 53. And then we'll get to the extinguishment accounting. This 54 question already we have done. I've put a tick here. This already we have finished. And 55 also already we have finished. So after finishing of CFI, then we'll be going to 56. Again, it is very, very, very important question. Okay. Right. So that's what we're going to do in this particular session. Let's start with this one, Anna. Question number 50. On 1st October 2017, Axe Limited issues preference shares to B Limited for a consideration of 18 lakhs. Okay. This is the proceeds. The holder has an option to convert these preference shares into fixed number of equity instruments. They themselves told you that it is fixed number of equity instruments. So fixed to fixed test is satisfied. And who has the option? Holder has the option. All the important points are clarified in the question itself. Of the issuer anytime up to a period of 4 years. Okay. If the holder does not exercise the option, the preference shares are redeemable at the end of 4 years. So obviously, because he said nothing, it will be redeemable at par. Otherwise, he would have told you specifically that it is redeemable at what? Premium or something like that. Mostly redemption will not happen at a discount. Issue will happen at a discount. Redemption most probably will happen either at par or at a premium. The preference shares carry a fixed coupon of 5.5% per annum and is payable every year, which means it is a mandatory dividend. So you should consider that while calculating financial liability portion or financial liability component of the compound financial instrument. The prevailing market rate for similar preference shares without the so-called conversion feature is 8%. This is your untainted interest rate. Or you can also call it as a preference dividend rate, which we'll be using interchangeably. So don't try to tell me that, sir, you are calling it as interest. Actually, it should be called as preference dividend. Don't say that. We'll be using those terms interchangeably. Next, Axe Limited has an early redemption option to prepay the instrument at 20 lakhs on 30th September 2020. All right, which means after 3 years, 2018, 19, 20, right? 3 years after, which means 1 year before. If it exercises that option, so they've done the buyback as well. The interest rate has changed on that particular date. Obviously, that would have been given. On that day, if Axe Limited could have issued a 1 year, so-called preference shares, they could have issued at a percentage of 6%. Okay. Right. What else? Calculate the value of liability and equity components at the date of initial recognition. Okay. Initial recognition is asked. Value of liability and equity. Obviously, we'll do that. Is nothing but normal CFI accounting. Also give amortization schedule. Okay. Okay. Where is the buyback? See, this is what ICA does. Entire information is about buyback. The question is also about buyback. The data is given, but the question he did not ask about buyback. You got it. So we have to do normal CFI accounting. That's all. In question, he did not ask you anything about buyback now. That's a easy peasy question. You get it? That's what ICA does. JICA. Anyways, right. You guys done with the reading? If you're done with the reading, we'll start. I'll give you some 20 seconds. That should be fine. And then we'll start. All right. Done with your reading? Chalo. Fatafat, we'll finish it off. No need to copy anything. I'm just gonna do it a tad bit faster. Okay. First, we need to find out fair value of financial liability and equity component. Correct? Of CFI. Don't use CFI. The wording is 8% preference shares. Use the word 8% preference shares. Okay. In the examination. Now, so what we'll do? Obviously, first we'll try to find out fair value of the financial liability. So we'll have years as one column, contractual cash flows, present value factor at what is the untainted interest rate? 8%, uncorrupted. Discounted cash flows will be the last column. Okay, here also same stuff, Nana. Yeah, 1, 2, 3, 4. 4 years only. right? What will be your interest that you'll be paying, the coupon rate? It is at 5.5%. So 5.5% into 18 lakhs. 18 lakhs into 5.5%. It will be 99,000. So 99,000 first year, 99,000 second year, 99,000 third year, 99,000 fourth year. Plus, because the redemption option is in the hands of the holder, he may ask for redemption, he may ask for conversion. So therefore, there is a chance of him asking for redemption. We should consider that as an obligation. Therefore, redemption also will come, and it's gonna be at par because there is no information in the question. We're gonna presume that the redemption will be at par. Now, how to solve this in a faster way in the examination? Take this at annuity. Annuity means 99,000 into, multiply that with present value annuity factor, or you can also call it as cumulative discount rate at 8% per 4 years. That is equal to 99,000 into 1 divided by 1.08 equals to grand total 3.312. 3.312126. Okay, I'll take it as 3.312. You multiply this, you'll be getting 3,27,888. Then what about this one? This you're gonna redeem after 4th year. So take 4th year discount rate. 1 divided by 1.08. 1, 2, 3, 4. It is given in the question, huh? Discount rates? No, it is not given. Okay, so it will be 0.753. Sorry, 0.735. 0.735. How much will be the multiplied value? 18 lakhs into 0.735. 13,23,000. So your financial liability value, fair value, is how much? Add this and tell me. 16,50,888. Okay. Total proceeds. In this question, he did not use the word proceeds for compound financial instrument. He has used the word consideration. You can also use the same word. Like that, you got to adjust on a question to question. You got it? So don't be rigid. No, we'll write the word proceeds only. In this question, what is the word he has used? Consideration. So just use the word consideration. Okay. How much is that? 18 lakhs. Obviously, the difference is nothing but your equity component. Equity component. How much is that? 1,49,112. Okay, what did he ask you in the question? Calculate the value of liability and equity components at the date of initial recognition. Yes, I'm done with that. Also give amortization schedule. Okay, that's it. He didn't even ask you to pass the entry. That's it. We did calculate the equity and liability component. Na? That's all. Ho gaya. Then he has asked you amortization schedule, which means for the liability component, we need to show the amortization table. Okay. Now use the same word, amortization schedule. Sir, why are you using this word, sir? Because that's what he has asked in the question, which is nothing but our ACM table. Try to be flexible with the question. That's how you score good marks, okay? So we'll be having years, not years, particulars. Years will come as the columns, na? So 2017, 18 is the first year. 17, 18. It's 17, 18. Check that once. 17, 18 is the first year. 18, 19, 19, 20, 20, 21. That's all. So opening balance. For this, we'll add interest expenditure because we're typically talking about financial liability. That is our interest minus contractual cash flows. Okay, you'll be getting your closing balance. Now tell me one thing. Opening balance kitna re? Financial liability 16,50,888. 16,50,888. Correct. Add interest expenditure at how much percentage re? The percentage of interest is 8%, na? Uncorrupted interest at 8%. So 16,50,888 into 8%. 1,32,071. 1,32,071. So this is the actual interest. Okay, based on this actual interest, we'll increase the liability value. And then once you pay the coupon rate is how much? Contractual cash flows at how much rate of interest? 5.5%. Yeah, 5.5%. That how much we already know. 99,000. We have already calculated. So write that 99,000 here. To that extent, you'll reduce your liability value because you made the payment. Automatically, your liability gets reduced. So what will be your closing balance? 16,83,959. So 16,83,959 plus again this one will be 1,34,717 at 8%. Then again you'll reduce 99,000. Your closing value will be 17,19,676. Again 17,19,676. This will be 1,37,574, that is into 8%. This will be 99,000. So you will be getting 17,58,250. Again this will be 17,58,250. You'll be adding 1,40,750. This will be balancing figure, Nana. Once you reduce 99,000, it should be exactly equals to 18 lakhs. Huh? Correct? And then you'll do redemption of 18 lakhs. Let's check this once. 17,58,000 plus 1,40,750 minus 99,000. Exactly, it should tally. Thus that you accordingly change this particular number. This will be the balancing figure. Please try to understand. You know that at the end of the day, it has to be 18 lakhs. Okay. So you match this number such that it tallies with 18 lakhs. You got the point? That's it. Your amortization table is done. The question is about buyback, but that he did not ask you anything about buyback. So what we did is normal CFI accounting. That's all. You understand the point? Nothing is there in this particular question. Easy peasy. Let's move on to the next one. So this is your ICA answer. Okay. Chala, moving on to 51. Come to question number 51, Nana. Alright, Nana, moving on. 51. The amortization schedule of the instrument is set out below. Okay, he himself gave you amortization schedule. So this is your ACM table, right? Okay, initial outflow. Okay. Fair value of your liability, fair value of the equity. Then fair value of the liability, what you will do, 9,24,000. You will add the effective rate of interest and you will reduce the contractual cash flows. Slowly your liability value will increase and again you will add effective rate of interest, you will reduce contractual cash flows. Again slowly your liability value will increase. And finally, you will be adding your effective interest such that after adding this in the last year, it will match with the redemption amount. Got it? Fantastic. So, and your equity will stay put. That's why it is staying what? The exactly same amount. So this we know. We know this, but it is presented in a different way. Our presentation is a lot more easier. Okay. I hope you guys can understand that. Assume that D Limited has an early redemption option to prepay the instrument at rupees 11 lakhs. Okay. On 30th June 2003. Which means 1 year before. 1 year before. So this is when the buyback is happening. All right. At 30th June 2003, interest rate has changed, obviously, because we need to find fair value of financial liability to split the so-called buyback price amount, correct? At that time, D Limited could have issued a 1 year, a non-convertible instrument at 5%. Calculate the value of liability and equity components. Okay. Now, understand one thing. He is not asking you to calculate value of liability and equity components during initial recognition because that is already given. So therefore, from that, you need to understand that when he's asking you calculate the value of liability and equity components, he's asking you at the time of buyback, or repurchase. You got the point, which is nothing but early redemption. All these are different names, Nana. Buyback, repurchase, early redemption. You got the point? So he's asking you to calculate the value of liability and equity components during buyback. During buyback means what? Whatever the buyback price that you've got, which is the price over here, 11 lakhs, this has to be divided into, right, equity component and liability component, right? Liability component is what we'll calculate, where future cash flows will be discounted at latest interest rate, which is 5%. Then you'll get the fair value of liability. And then you'll be comparing that with the, when it comes to equity from the consideration, that is 11 lakhs, you'll reduce the fair value of the liability, you'll be getting the fair value of the equity. That's all. He did not ask you profit and loss as well. That's all he has asked. That's it. Easy sum, right? You guys are done with your reading? I'll just wait for 20 seconds, then we'll start solving. Right, let's solve this. Question number 51. We need to just find the fair value, Nana. So calculation of fair value of financial liability on buyback day. Correct? How to calculate this? You just need to discount the future cash flows at market interest rate, correct? On that particular day. So what is your future cash flows, Ray? There's only 1 year cash flow. So 1 year, what's gonna be your cash flow? Year, contractual cash flows of future, your present value factor at 5%. Why 5%? That is the interest rate, uncorrupted interest rate as of today. As of today means what is today? Buyback day. And then you'll be getting your discounted cash flows. So it's gonna be 4th year. That is the last year, na? What will be your cash flows? Two cash flows will be there in 4th year. One will be your interest, which will be 60,000. The other one will be your principal repayment, which will be 10 lakhs. Correct? That's what the cash flows that you'll be expecting 1 year from now, because already you're at 3rd year ending. So next year, what's going to happen? You'll be having this interest payment as well as the principal redemption, right? Obviously at par. So present value factor at 5%. So what will be your present value, Nana? 1 divided by 1.05. This will be 0.95238. So 952 only. 3 digits is enough. So 60,000 into 0.952. 57,120. This will be 9,52,000 lakhs. 0.952. At 52,000. I don't want to, I did take some approximation over here, so that should be okay for you. 9,52,000 plus 57,120. 10,09,120. All right. So this is your fair value of financial liability component on buyback date. From this, reduce the consideration. How much is the consideration? 11 lakhs, you're paying for the buyback? Yes. So, minus 11 lakhs. 90,880. Approximation will be there between your IC answer and our answer, okay? 19,880. Got it? So what is this 90,880? Fair value of equity component. That's it. Your problem is done. That's what he has asked you to calculate. After this, don't compare this with the carrying amount of financial liability and equity and then calculate whether there is profit or loss. When it comes to financial liability, if profit or loss will be taken to P&L account. When it comes to equity component, profit or loss will be taken to what? Retained earnings. It will be adjusted against retained earnings and then passing the entry. All those things are not necessary. Did he ask you that? Did he ask you that? No. Stop here. What did he ask you in the question? Calculate the value of liability and equity component. Did we calculate the value of liability and equity component? That's it. Job done. Stop there. No need to do anything else. Don't overdo your answer. You got the point? Don't overdo beyond what has been asked in the question. Clear? Are we done with this? Shall we move on to the next question? Everybody? Fantastic. Let's move on. 52. Moving on to the next one. So, Adventure Limited issued 20,000 9% convertible debentures of rupees 100 each at par at the beginning of the year. Okay. The debentures are of 6 years term. Okay. The interest will be paid half yearly. Here comes the twist. Half yearly means you should count it as periods. Even though it is 6 years, you should call it as 12 periods. Okay. The word you should be using is period. 12 periods. Each period represents 6 months. What else? The debenture holders have the option to get 50% of the debentures converted into 2 ordinary shares at the end of 3rd year. Okay. All right. The debenture holders who do not opt for option will be paid 50% of their face value at the end of 3rd year, which means after at the end of 3rd year means after 6 periods. After 6 periods. Always look at this question in terms of periods, Nana. This is where you'll get confused, okay? Right. The debenture holders who do not opt, that's fine. The balance non-convertible portion will be repaid at 10% premium at the end of the term of the debentures, which means after 12 periods. It will be repaid after 12 periods with 10% premium. All right. What else? At the time of the issue, the prevailing market interest rate for similar debt without convertibility is 10%, obviously. Just 1% difference. Okay, because the conversion is not full. I can understand. That's why the difference is not much, just 10% and 9%. Otherwise, it would have been 10%, 7%, 10%, 6%. I hope you're getting what I'm trying to say. Present value of 1 rupee at the end of 3 years at 10% and 5% is given. Discount rates are given. Present value of 1 rupee at the end of 6 years, 10% and 5% discount rates are given. Compute the liability and equity component and pass necessary journal entries recognizing the issue of debentures. Recognizing the issue of debentures means we need to understand that it is initial recognition. It is initial recognition. It is initial recognition. So this is a good sum. Okay. Now I'll give you 30 seconds. You read the question, understand that, then we'll start solving. You and me will do it together. Okay. Right. Just read the question. Done with the reading? Shall we start? All right. Question number 52. Okay. Now let's try to understand what's happening over here. What is the initial total proceeds of the debenture? Issue 20,000 debenture at 100 each, right? So total proceeds of debenture initially. Proceeds means you can also call it as a consideration, or sometimes people also call it as a face value. Proceeds or consideration or face value, not fair value. Okay, face value. Anything is nothing but the same. No. How much is that? 20,000 100. Okay, 20,000 into 100. That will be equals to 20 lakhs. 4, 5, 6. 4. All right, so it's 20 lakhs. Now this is the total amount that you have received, correct? Now usually we'll not be calculating coupon rate and all that, but here we need to calculate because you're gonna pay coupon not per annum but per period. So coupon amount payable, okay, for each period. Now what is each period? 6 months. That will be your normal 20 lakhs. I hope I've put the zeros correctly, into 9%. This is what it is because your coupon rate is 9%. Normally this is it, which means 1,80,000 is what I'll pay per annum, but here that's not the case. Into 6 by 12. 6 months divided by 12 months. So you'll be paying actually 90,000 per period. Sir, why are you calculating all these things, sir, per period? You'll understand because that's how we can calculate the fair value of the financial liability. Because unless we know future contractual cash flows, see, how will you calculate fair value of financial liability? That you tell me. Sir, the question is all about initial recognition only, na, sir. Question is all about initial recognition only. What is there in initial recognition, sir? You calculate fair value of the financial liability. You reduce it from the total amount that you have received. You get your fair value of equity. That's all. Your job is done. That's what he has asked. Na? Compute the liability and equity component and pass necessary journal entries. Okay. Entries also I'll pass bank account debit to what? CFI financial liability, CFI equity. In the place of CFI, you can also use the word 9% convertible debentures or 9% debentures, financial liability within brackets, to 9% debentures, equity within brackets. You'll get the amount. Once you calculate the fair value of financial liability, you reduce it from the total amount that you have received, which is 20 lakhs. You'll be getting fair value of equity. There ends the matter. That's all. Entry is also done. But the question is how to calculate fair value of financial liability. That's where the twist comes. Fair value of financial liability is nothing but what? All the future contractual cash flows discounted at uncorrupted interest rate. What is uncorrupted interest rate? 10%. You should discount that. What you will discount? Future contractual cash flows. And that's where the complication is there in this question. The so-called future contractual cash flows is not simple in this particular question. There's a lot of layers. You have first layer where it is paid half yearly. That is the first layer. Apart from that, you see a lot of things are happening over here. At the end of third year, you understand the point? What is happening? The debenture holders have the option to get 50% of the debentures converted to 2 ordinary shares at the end of third year. If you don't opt for conversion, then you will be redeemed. Redemption also will happen at the end of third year itself. So at the end of third year, 50% redemption will happen for sure, or the conversion will happen. After third year, only the non-convertible portion will be repaid at 10% premium at the end of the debenture. That is after 12 periods. After 12 periods means after 6 years. So there are a lot of layers over here. You understand the point? That's where calculating the financial liability value, the fair value of the financial liability, which is nothing but discounted at market rate of interest, that is 10% for the future contractual cash flows, which we usually do, is not that simple in this question. You understand the point? You'll understand. Just wait. Let's go with the flow. Till here it is clear now, right? What did we do? We calculated the initial proceeds and then we calculated the interest per period. Interest per period. This is nothing but coupon amount payable, contractual cash flows. Contractual cash flows only now we have to discount to find out the fair value of the liability during initial recognition. You got the point? Everybody is clear? Alright, fantastic. Okay. Still it is not yet done because you have to discount all the future contractual cash flows for the entire 12 periods or 6 years. For entire 12 periods or 6 years means we have to take into consideration a lot of things. Okay, now what is the next thing? Let's go to year 3. Year 3 end. Year 3 end means what? Period 6 end. Are you getting the flavor? Right, fantastic. Now, what I have to do at year 3 end? I can either convert or I can redeem. Tell me one thing. Now we are calculating the fair value of financial liability, right? And the option is in the hands of the holder. Debenture holders have the option. Now tell me one thing, so many times, so many sums that we have done so far, when the debenture holder has got the option to either convert or redeem, what shall we do? We will feel as if he'll go for conversion option. We will feel as if he goes for redemption option. Because tomorrow, suddenly if he asks for redemption and if we say no, it's not going to work. So if he asks you to redeem, you have an obligation to pay. So therefore, while calculating the fair value of financial liability, we'll consider that he will ask for redemption. We will consider that he'll ask for redemption. That's why in the last year, we'll take the redemption value and then discount it. And then we'll calculate the fair value of financial liability during initial recognition. This we have done so many times, correct? The only difference in this question is that instead of waiting till the last year, we are doing it in midway. Because in the question, he said year 3 ending, that is the midway during half. Okay, half of the journey. He may ask you to convert 50% or redeem 50%. So here, from our perspective, when we calculate fair value of the financial liability, we'll feel as if, suppose if we ask for redemption, then we have an obligation to pay. Therefore, I need to consider that while calculating my financial liability, because financial liability is all about your obligation. Do I have an obligation to repay at the end of year 3, at the end of period 6, 50% of the amount? Do I have an obligation to pay? Yes. In case if he asks, you cannot say no. So you have an obligation. So consider that. Obligation to pay. If holder asks for redemption. Don't write this in exam. Don't write this in exam. This is only for your understanding I'm writing, so that tomorrow when you revise, it will be easy for you. Get it? Is equal to how much? 20 lakhs into 50% only, na? 10 lakhs. Clear? Done? Okay, this is your obligation. That's a liability which you have to discount. Then, next, coupon amount. Coupon amount. Because why are we talking about coupon amount? because these are all contractual cash flows. Contractual cash flows only now we need to discount to find out the fair value of liability for initial recognition. You get it? Coupon amount from year 4, because year 3 is done. Till year 3 it is done. From year 4 to year 6. 4, 5, 6. Which means 3 years. 3 years. Or 6 periods. 7th period to 12th period. Correct? Huh? 3 years or 6 periods. 6 periods means 7th period to 12th period. Got it? How much will be the coupon amount? Now you will not be calculating 9% interest on 20 lakhs. Earlier we calculated 9% interest on 20 lakhs. Now where is 20 lakhs? 10 lakhs has been repaid now. So you'll be left over with only 10 lakhs. You'll be left over with only 10 lakhs. 10 lakhs into 9% into 6 months divided by 12 months. This will be your coupon rate of interest payment, which will be only 45,000. Hereafter, you understand the point? Not 90,000. Only for first 3 years, first 6 periods, it will be 90,000 per period. After that, last 6 periods or last 3 years, it will be 45,000 per period or 90,000 per year. Initially, it is 90,000 per period or 1,80,000 per year. Clear? Okay. Now, finally, we have to come to the last end of, that is year 6 end. Year 6 end or period 12 end. Okay. What about here? Your obligation to pay, to redeem at 10% premium. So it will be 10 lakhs plus 10%. 11 lakhs is what you need to pay to redeem. That's an obligation. When it's an obligation, it comes under financial liability fair value calculation. You got it? Now, to find out fair value, what I have to do? Now that I know all the future contractual cash flows. Once I know these are all the contractual cash flows that's going to happen in another 12 periods or another 6 years from now, I can discount it and calculate the fair value of financial liability which has been asked in the question. So now I can calculate fair value of financial liability component on day 1. We are doing all these things to calculate the initial recognition. Initial recognition means day 1 only. Columns will be period, not years. Contractual cash flows. Present value factor at what is uncorrupted interest rate? 10%. Uncorrupted interest rate is 10% for the entire year. Per period 5%. Discounted cash flows. You understand the point? It is 10% for the entire year, but here we are not taking years now. Here if I have taken year, here I'll be taking 10%. Here I have taken period, which is 6 months. Therefore, for 6 months it will be 5%. Simple. So it will be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Correct? Contractual cash flows. First period, first 6 months, 90,000 interest. Okay. Next 6 months also 90,000. 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 Correct? Next 6 months will be 90,000. Third year ending, 6th period. It's gonna be 90,000 plus 10 lakhs. Because you'll be redeeming, na? He can opt for conversion option also, but is there a chance for asking? I mean, is there a chance where he'll ask you to redeem? Yes. If there is a chance, do I have to pay 10 lakhs? Yes. Then consider that in calculating your financial liability. That's what we have been doing so far. So 90,000 plus 10 lakhs. Okay. Hereafter, 7th period, 45,000. Bol rahe? Again 45,000. Again 45,000. Again 45,000. Again 45,000. Last period. That is last year ending. 6th year ending. It will be 45,000 plus. Plus what? Just now I've calculated now here. You need to redeem 11 lakhs. You got the point? You see, these are all your future contractual cash flows. This should be discounted at market rate of interest, that is not 10% per year or 5% per period. Then only will be getting discounted cash flows. That is nothing but your fair value of financial liability. Then you reduce it from 20 lakhs, you'll be getting fair value of equity. You understand the point? So to calculate fair value of financial liability during initial recognition only, we have to do all these things. Clear? Huh? Now 1 divided by 1.05. 1 divided by 1.05. 0.9524. Point 95238, so 24. 0.9070. 0.8638. 0.8227. 0.7835. 0.7462. 0.7107. 0.6768. 0.6446. 0.6139. 0.5847. 0.5568. Okay, we cannot waste time on calculation. I've already done that. So once you calculate this, you discount it and then total it up. Fair value of financial liability component will be 19,85,922. Why the liability component is very high out of 20 lakhs? Because there is an obligation to redeem. Whenever there is an obligation to redeem, the fair value of the financial liability component will be much higher. Your equity component fair value will be much lower, just like a residual value. Okay. So total consideration or total proceeds of compound financial instrument is how much? 20 lakhs. So what will be your fair value of equity component? 14,078. He has asked you entry also now. What will be your entry? Bank account debit to CFI financial liability to CFI equity. In the place of CFI, what can you write? You can write 9% convertible debentures. In the place of CFI, you can write 9% convertible debentures. So this will be 20 lakhs you will receive. This will be 19,85,922. This will be 14,078. This is your initial recognition. Initial recognition. Date will be, what will be your date? Did not give you any date. No date. Okay, just he told you these many years, that's all. Which year he did not tell you. That's it, Nana. Done. Done and dusted. Clear? It's a good sum, mark it. And you have to revise it the day before the exam. Finished? One more sum and we are done with CFI. One more sum and we are done with CFI. Okay? Any doubts with respect to this sum? I've done the solution over here, don't worry. Entire solution has been done, no need to copy. So last question of CFI. All right, last question of CFI, not this chapter, okay? Now, K Limited issued 5,06,000 convertible debentures at 10 each on 1st April 2001, okay? The debentures are due for redemption on 31st March 2005, okay? 4 years. At a premium of 10%, okay, convertible into equity shares to the extent of 50% and the balance to be settled in cash to the debenture holder, just like the previous sum. But here in between it is not happening, it is happening at the end, but 50-50. Okay. Which means the gap will not be much. Here it is, gap is also much. The interest rate on equivalent debentures without conversion rate is 10%, whereas ours is 6%. You are required to separate the debt and equity components at the time of issue. That is initial recognition, just like the earlier sum. Show the accounting entries in company's books at the initial recognition. The following present values of rupee 1 at 6% and 10%. Okay, just like the previous sum, but lot more simple. In the last sum, we had this 50% conversion and redemption, but we had that in between, in the middle, as well as at the end. And we had the interest payment going on for 6 months. Therefore, that periods and years confusion, all those things were there. Here, all those nonsense is not there. It's much simplified version, okay? It's easy peasy. You read the question, we'll solve it in another 2 or 3 minutes. Read the question, Anna. I'll wait for 20 seconds. After that, we'll solve. All right, let's solve this, Nana. 53rd question. Now, so we need to find fair value of financial liability during initial recognition, correct? Okay, so you're gonna have years, contractual cash flows, present value factor at 10% because 10% is the uncorrupted rate, right? Yeah, the corrupted rate is 6%. Chalo. Then discounted cash flows from which we'll be finding fair value of the financial liability. So the years will be how many years? 1, 2, 3, 4. Contractual cash flows will be how much, Nana? How much will be your 6%, right? So 3 lakhs into 6%. This will be 3 lakhs. How did you get 3 lakhs? 50 lakhs into 6%. How did you get 50 lakhs? You can see that in the question, Anana, 5 lakh into 10 rupees, right? So 50 lakhs. 50 lakhs into 6%. That will be your 3 lakhs. So 3 lakhs will be your contractual cash flows for a period of 4 years, right? Again 3 lakhs. Again 3 lakhs. But in the 4th year, you'll be having the principal repayment as well. How much? Only 50% will be repaid, right? Will be redeemed. 50% will be convertible. Here, the debentures are due for redemption at a premium of 10%, convertible into equity shares to the extent of 50%. So there is no choice over here. It will be converted into equity shares for 50% and the balance will be settled in cash. Right. So in that case, I should be taking only 50%. So 50 lakhs into 50%, that will be 25 lakhs. And this 25 lakhs also will be redeemed at 10% premium. So you multiply with 110%. So 25 lakhs into 110%, how much it will be? 27.5 lakhs. 27 lakh 50,000. Got it? Now that should be multiplied with the discount rate. Now this is 10%. 1 divided by 1.10 is equal to first year, second year, third year, fourth year. 0.683 is the fourth year. Now for this, anyway, it is annuity. So what I'll do is that 3 lakhs, I'll multiply with present value annuity factor at 10% per 4 years. So 3 lakhs into 1 divided by 1.10 equals to 4 years grand total. 3.169. I'll take it as 3.17. So 3 lakhs into 3.17 will be how much? 9 lakh 51,000. 27 lakh 50,000 into 0.683. 27 lakh 50,000 into 0.683. 18 lakh 78,250. Just check this value, Nana, once. Okay. So what your ICA has done is instead of 0.683, they have taken 0.68. They have taken little bit of approximation. If you take 0.68, then the answer will be 18 lakh 70,000. They have taken 2 digits, Nana. 2 digits. You can also take 3 digits. It's not a problem, but they have taken 2 digits. Okay. Right. The total will be 18 lakh 70,000 plus 9 lakh 51,000. How much it will be? 28 lakh 21,000. This is fair value of debt or financial liability component. So what is your total proceeds? which is nothing but total value of compound financial instrument, which is 50 lakhs. Then easily you'll be getting fair value of equity component. How much is that? 21 lakhs 79,000. Now we can pass the entry. Bank account debit to 6% debenture, financial liability component to 6% debenture, equity component, which will be 50 lakhs. How much you will receive to your bank account? And this will be 28 lakh 21,000, 21 lakh 79,000. So being profits recorded at fair value. Got it? That's it. You just need to do initial recognition. That's it. Nothing else he has asked you in this particular question. Finish it off, guys. So with this, we are done with CFA completely. Okay, next question onwards, we're gonna go for extinguishment accounting, where if I'm clear with respect to extinguishment accounting, there is nothing but derecognition of your financial liability. We are already done with 54. We're already done with 55. Okay. So which means we'll be continuing with 56 in the next session. That's it. You revise and come a little bit of derecognition in the next session. Okay. So we're done with CFI. Next will be derecognition of financial liability. That is loan modification also comes under that only. This substantial and non-substantial is there. Na? This you revise it and come in the next session. Get it? Alternative 1, alternative 2. Straight away we'll get into sums. Because already we have covered the concept and we have covered 2 sums as well. So we're gonna go with 56. So it's your job to revise and come. Straight away I'll start with 56th question in the next session. Clear? Right. Chalo.